Record. Okay. So today we are really just focus on planning your tax for 2022, and as a strategic tax payer, and we will talk a bit more about what I mean by strategic. So in this process, try to keep asking yourself: are you overpaying tax, and what kind of taxpayer are you, and what strategies can I use this year? So a bit about myself: I'm a CPA, I'm a tax strategist for entrepreneur, and myself is also an investor and entrepreneur. And I call myself master of tax planning. That's what I learned, and I strive to be the master of tax planning that can help entrepreneurs to save tax and grow wealth. So first, I want to focus on some big picture thinking. And today, we will talk about a few strategies, but really all these strategies behind it, I want you to learn the fundamental way of thinking, okay? And these are more important than the strategies. So first big picture thinking, let's play a game. You can read along with this. Newspaper is better than a magazine. Seashore is better than the street. Even young children can enjoy. Birds seldom get too close. Rain, however, soaks in very fast. One needs a lot of room. Okay, how do you feel? What are you getting? We can be spontaneous. You can unmute and just talk since we have only a few people here. Right? It's like everywhere, like, what are you talking about? It does not make sense, right? So now let's read it. Kite. Read the title, Kite. Newspaper is better than magazine. Seashore is better than the street. Even young children can enjoy. Birds seldom get too close. Rain, however, soaks in very fast. One needs a lot of room. Now, how do you feel? Start to make sense, right? You're talking about a kite. So start to make sense. So what I mean is here, the bigger picture or the context or the thinking behind the thinking, it's very important. When I say context, for example, for tax, the first most important thing is really, does it make sense? Does your tax return make sense? Most of the people who are audited are invited. They created their tax, does not make sense. And really, IRS, there's nobody at home. What I mean is, you go through the computer, go through the system will look at it, it makes sense or not. If it does not make sense, it's spit a letter. So first, making sense, it's more important. The story is more important, okay? And then that's just one context. Another context is the big picture thinking. For example, modern monetary theory. So we had the First World War and then Second World War. And then after that, we created something, using the monetary policy, right? Issue money to stimulate the economy. And we do that during the 2000 tech bubble and 2008 financial crisis and 2020 pandemic, and continue to do that. And this is better than war. So this is no turning back. So the bigger picture, long-term big picture is always inflation. Right. So with that said, well, how does that impact your financial decision? You probably want to, get a loan and buy real estate, right? Buy real assets, thinking this way. That's bigger picture thinking. So, and then another big picture you want to think is really your future. Tax planning is about your future. Like, what kind of future you want? what kind of life do you want when you retire, 30 years from now? You really think from now on forward, and you plan as early as possible. And then you have short-term, long-term, you have kids. Yes, the kids are still 10 years old, but you're thinking about college financial aid 10 years down the road, right? So your future is important. So these are contexts. And again, later on, we will see other contexts I create. So this is just one more example of the story, right? Just the financial. If you look at this business, does this make sense? It makes sense for the accountant. It's alphabetical order, it's in order, but does it tell a story? Now I reorganized it. Does it tell a story? Right? It's much easier to understand the story. Okay, primary staff, that's the main staff. And these are flexible, and the primary staff is half of the cost. These are flexible staff based on cases. And these are the resident services that's probably fixed cost. And these are probably also fixed cost, right? And the story makes sense. It's easier to understand. So these are all contexts for tax. Okay, I created 5 contexts. The first context is intention. So in the entire world of tax laws, only 1% of the tax law is saying you need to pay tax. Here you need to pay tax. Here stop, pay tax. 99% of the tax laws are written to tell you, here you don't have to pay tax. Go this way, go return, go turn right, go turn right. This is green light. This is how you should not pay tax. Now, the intention of this is to create these incentives to incentivize citizens to take care of yourself, your family, your business, your community, so that you don't have to. The government doesn't have to. Okay, the government is not efficient. Private citizens and the community are more efficient. Okay, so that's the intention behind it. And that's why Warren Buffett says, I pay less tax than my secretary. So learning the tax laws and finding ways not to pay tax, you are being a good citizen. Structure. So I'll show you a bit later. And the strategies. There are only 3 strategies. All the strategies add up. There's only 3 strategies at a larger context. Okay, we'll talk about. And vehicles. If you use the strategies and then you relate it to vehicles, now you can implement your strategies. And in America, the big vehicles are real estate, business, and tax saving. And tax saving are usually together with real estate and businesses. And then content. And the content, you can also help yourself understand them by categorizing in 2 categories. One is code-based, one is product-based. Okay, code-based, like the section 1202, qualified small business stock, 401k, all of these product bases like insurance, annuity, right? These are product-based. So structure. The structure is basically, you start with income, and that includes business income here. So wages and business income. And then here you have adjustment to income. And here the major ones is retirement saving, okay? And then you have the itemized deductions. The major ones, interest and contributions. And the contributions could be very large. I would share some examples. When you have quite some money, charitable strategy, it's a big strategy. And then you look at standard deduction versus the itemized deduction, see which one is bigger. Usually, you choose your itemized deduction is bigger. And then you take whatever credits that's available for you. And today, this year, I believe the green energy strategy, the 26%, this is the last year. You probably want to take advantage of it. So with that said, the first strategy is to take as much as possible, take advantage of all the adjustments to income and the itemized deductions. That's the first strategy, okay? And here we will look at mostly the retirement deductions, okay? And then here mostly the contributions, charitable strategies. So that's one strategy. So then the second strategy is to use money that is saved. No, let me pass. The second strategy is to call income shifting. You really shift your income to, for example, the 401k, IRA. It's really shifting income to your future self. Now, they are also shifting between each other. You can shift income from your S Corp to C Corp. You can shift income from California company to Nevada company. You can shift income from a US company to Cayman Island company, right? It's all shifting. You can shift your income, from yourself to your children, or shift expenses from yourself to your children. Okay. For example, if you live in your house and the house is paid off and you retire, you don't have income, well, you sell the house to your children who are making $200,000 a year, and then they can rent back to you. So it's a rental income for them. It's a rental deduction for them, right? You pay them rent, and then they take the depreciation and the interest. Okay, so there are ways to do all of these. And then with the first and second strategy, you save the tax, otherwise the money otherwise will be paid to tax. Now you invest for your future. Okay, and then some of the investment is pre-tax, like 401k, but some of the money is after tax. So like life insurance, like Roth IRA, and that gives you the third strategy, to earn as much as possible tax-free income. Okay, so one strategy we use is put money into 401k retirement plan as much as possible, and then convert into Roth IRA when your income is low. Okay, like when you first retire or when you take a few years off. So as we mentioned, the three strategies, right? One is to earn as much as possible the tax-exempt income. And this is really the long-term wealth creation strategy, because that money is usually big. It's usually capital gain tax. And then, some of the charitable strategy I will share with you will give you that as well. And some of the strategy I share with you will be a combination of all these three strategies. And then take advantage of the deductions and the tax credit. And then, of course, the income shifting. So, as I said, in the tax code, there are green lights saying stop, pay tax. And then there are red lights, stop and pay tax. And then there are green lights, turn right. So, for example, red lights, Section 1, tax imposed for all income. 1401, self-employment tax, if you are Schedule C or partnership. 1411, net investment income tax, if it's a passive income. And here are green lights. So 105, medical expense reimbursement plan in your business that will escape the itemized deduction of medical expense, which is subject to 7.5% of AGI. Only the medical expense above 7.5% of AGI can be deducted as itemized deduction. But here, if you put it in your business, you create a medical expense reimbursement plan, then you can deduct the full thing, right? So talking about that, the rental deduction. Usually you have $25,000 rental deduction, but your income is more than $150,000, you can't deduct it anymore. Well, what if it's a business? It's just business you run. Now business has no limit to deduct, right? Instead of putting it onto Schedule E, now it's a business. You have an LLC and you have a K1. So you can even do cost segregation, and you can have $1 million deductions to offset whatever $1 million income you have. It's all possible, right? So these are ways you can think creatively by studying the green lights. Okay. So charitable contribution is a big one, and including 501c3, it's a big green light. 401k, 401h, most of us already know, and self-insurance. It's also called captive insurance. It's also a shift, income shifting. This is a deduction plus income shifting strategy, right? If you shift from your operation business to your insurance company. So, and then the tax-free withdrawal, which is for the insurance contract. You basically earn tax-free income. And then the section 1202, capital gain for qualified small business stock for $10 million. Okay, so think about all of these things will help you create a wealth rather than wasting money on tax. These are just the examples. So really key to the tax cutting is the timing. When you recognize, we can shift some to the future, like 401k, and shifting to different entities, and then look at some of the code, and then use some of the products like insurance and annuity. Okay. So fundamentally, there are 3 stages you needed to pay tax in an investment. One is the seed, one is the growth, and one is the harvest. And let's look at different products. So a regular taxable stock in your brokerage account, the seed, it's not tax deductible, it's after tax. And the growth part of it, it's taxable. And the harvest also, when you sell it to the capital gain part, is taxable. And the traditional IRA, you got a break with the seed. It's after tax. And the growth, you don't have to pay. But when you take it out, you have to pay tax for the entire proceeds. Okay. Now, Roth IRA, it's after tax contribution. And then the growth, and even if you take it out, you don't have to pay tax. Okay. So one strategy we use is to take advantage of the traditional IRA and qualified plan as much as possible to save tax now. And when you don't have much income, you convert to Roth IRA to create long-term capital gain, free capital gain. And then annuity itself is after-tax money, and then it grows. It's free from tax, but when you take out, you have to pay tax. Now, annuity could also be a product under the shelter of Roth IRA or qualified plan. And then it will take on the characteristics of the Roth IRA or qualified plan. Okay. And then permanent life insurance is just like Roth IRA. The seed is after tax, and then the growth and harvest, you don't have to pay tax. Okay. Health saving account, interestingly, the seed, the growth, the harvest, none of them you have to pay tax. And I always take this, like if you're healthy, you don't use it, this is just a wonderful IRA, wonderful retirement account, right? You get a tax deduction now, and you get a tax-free in the future as well. So just take advantage of it. Even if it's a small amount, it adds up over time. So that's something. It's only $7,200, but it still, adds up. And with that said, also I want to say the donor advised fund. So donor advised fund is just like a health saving account. you get the tax deduction when you put it in there, and the gross is tax-free, the harvest is tax-free, okay? And then the money you take it out, well, it's restricted for charitable purpose. Now, if you're charitably inclined, this is awesome. It's an investment. It's a tax-free investment, right? And then also, if you in the future want to do something about charity, you can still use that money. All I say is just be impeccable when you set things up. And I always give the example of Bill Gates. He has his wife and Warren Buffett and his co-founder as the board of directors. So at least 50% of board are non-families. And then, major things like his salary or, major programs, you have an email approval, things like that. That way it's not self-dealing. Okay. So when you use the money, the first strategy is use the tax deferred, right? And then the next one is the taxable. And then you leave the tax-free assets as long as possible, because this one, it grows and you don't have to pay tax. So that's the strategy when you actually use it. So now I'm going to share some of the strategy that we can apply right away. The first one is self-employment. So if you are having a Schedule C, a lot of real estate agents, a lot of insurance agents, they usually have a Schedule C, and their 1099 is in their personal name. And a lot of times they misunderstand, oh, that's, they only can do Schedule C. The problem with Schedule C is now if you make $100,000 net, you have to pay self-employment tax 100% times $100,000 times 15%. That's $15,000 right away. This is on top of your income tax. Okay, so the code for S Corp is this: you can divide your income into two portions. One is your salary, and one is dividend. So the salary portion, you just pay salary tax. In this case, 50%. Now you can just pay instead of 100,000 times 15%, and now 50,000 times 15%. That you save $7,500 right away. Okay. Now, interestingly, the IRS says you needed to pay yourself reasonable salary. Now, what is reasonable? There's no numbers. Okay, and I haven't seen they audit you for reasonableness. So, $100,000. If I pay you $10,000, maybe aggressive, but will it go by? Yeah, most likely. So $10,000. Okay, $1,500. Now you save $13,000, right? So think about that. This is a simple strategy you can use will immediately save you $10,000, $15,000. It depends on where you are, how much you're earning. $200,000 will save you what? 15%. 15% of $200,000 is $30,000, right? It saves you. The saving is actually significant. So 401k. So we talked about taking advantage of all the deductions, right? The major deduction here is 401k and retirement plan. So in this case, this is an S Corp, a husband and wife, making $160,000, $130,000, $290,000 total salary, and then $1 million K1. So $1.2 million taxable income, pay $500,000 tax. The leftover $700,000. Alternatively, we can set up a 401k, and we can set up a defined benefit plan, cash value balance, and cash balance and profit sharing. All of these, you can put more than $1 million into that. You can defer that amount, and you left $180,000. You live simply. You can still live it. But the money saved, these are your money. You can use, these are the seed that will grow as a retirement fund. And when you retire, you have a comfortable life. So rather than paying the IRS $500,000 you keep the money for yourself, and then pay that as $50,000. That's what's possible. And then you can convert. You can convert. One good timing is when, say, you take a sabbatical year, just go travel. Okay, you don't have much income. Do this. Convert some. Or in the first few years of retirement, convert some. So, as I said, another big deduction is the charitable strategy. So here I want to say some common charitable strategies first. So common strategy, the easiest one, you donate to a public charity. Okay, you can donate up to 60%. You can have deduction up to 60% of your AGI. Of course, you can donate 100%. That's fine. If you can deduct this year, you can carry forward next year. And then you can also create a public charity for yourself. You can create one, and then you can have some friends to be board members. And really, public charity is not yours. Right? It's public. By nature, by definition, it's public. It's not yours. So it's okay to do it to your own. However, as I said, just to cross the T and dot the I, have some other people to be on the board as well. And then you can put money there, and then you and your board, you guys run this charity for whatever purpose, research or education, something you do. Or if you don't do it, you just keep it there. It's fine. You can just invest the money and let it grow. Okay. Now, if it's a public charity, you need to file the 990 every year, and it will cost you probably $1,000, $2,000 to maintain that. Donor advice fund. It's really easy. You go to Fidelity, Charity, Vanguard Charity. You open one, just like the IRA, and you can buy some stocks, and then you pay. You can also deduct up to 60%, just like the public charity, but more easy. You don't have to report tax or anything. There's not an entity. It's just basically a trust. And there's usually very low fee or no fee. So that one, for small amount, I always advise this one, 100,000, 200,000, just choose this one. It's very simple. And you don't have to donate it. You just take the deduction right away. This money will sit there, and you manage it to let it grow. And then the private foundation. Private foundation, in comparison, public charity is basically public charity. You have to have 33.3%. Basically, 1/3 of the income comes from public, which means other sources, basically, other than one person, which is not difficult to do. You can, and then there's a 5 years of waiting period in the beginning. So, but private foundation basically says, okay, I don't care. I don't need to raise money from other people. I just do it by myself. Okay, not a problem. If you have enough money to put it in there, it's fine. You can do that. The only thing is you have to pay 1.5% investment income, which is not bad. Okay, and then the deduction is only 30%. And then you're subject to a rule called 5% rule, which means you need to distribute 5% of your assets every year. Okay, so that's this one. Now these two have no. Okay, so now if you really want to have privacy and control and everything, you can invest whatever you want to invest. That's a good one. Okay, charitable LLC. Now this one is getting very interesting. So Chan and Zuckerberg initiative is an LLC. I suppose what they did is they give the stocks to their LLC, and then instead of selling the stock, they can keep the stock, but they give, say, 98% of the membership to a charity, and then they can take the deduction. Okay, so that's very interesting. So this is very good. This is very good, including if you can put cash there, or you can put, donate your stock there, and then you give away interest. The good thing is you don't give away cash, right? The cash is still there. You can invest in real estate or anything you want to invest. So you still have full control. Now, the thing is this, people abuse it because it's so good. So people abuse it. And then the IRS is very much, watching everything. So when you do LLC, you probably want to have a lawyer and make sure, you do everything correctly. Because, you're just ready for audit and no problem if you do it impeccably. So make sure you have the true intention that, yes, I'll manage the money, I'll use it. And, but I have the true intention to donate to charity. So when I make money at a certain time, at least I should, donate some cash to the charity, right? So that will establish your true intention rather than a tax game. Okay. Now, one other way, it's very interesting. I met a lawyer and he has actually legal opinion and he can do this. So you can actually, instead of donating cash, you can actually create a loan from the charity and then donate that to charity. Now it's all paperwork, right? And then the thing is, you can't just do this paperwork. You have to establish your true intention. So the true intention is this: you can collateralize. You can use your life insurance or some property or assets as collateral for the loan. Now that makes it more serious, right? And you file the UCC. That's more serious. That can stand in front of audit, and the attorney actually has legal opinions. So it's very, very interesting, So if you want to use that one, I really think it's an awesome strategy, by doing that. And this is really kind of like reading the letter of the law, and now we're following the letter of the law, right? So doing it. But I think just make sure you have the true intention. You will donate some money, you have some charitable intention. So that's important. With that said, later on, I will show you some other strategy, taxable strategies like the charitable remainder trust that has enormous benefit. Really adding all of these things up, have more greater strategies, benefits. So this is an example, and this is a real case. We just changed the name. So this couple, they have a real estate property cost $2 million, and they sell for $10 million, and we have $8 million capital gain. So what we do is before we sell, we put this property into a pooled income fund, which is a charitable strategy. It's an irrevocable charitable trust. Now, when you sell it, it's not you selling it, it's a trust selling it. So you do not have to pay any capital gain. Now, on top of that, because you donated to charity, you get a deduction, charitable deduction, this amount. And this amount, of course, you probably don't have so much income to use for the first year. Okay, you can use it for the next 6 years. Okay, we'll give you some income saving. And then, even better, we put this fund, this principle, we put this fund, and we designate it as a private placement life insurance policy. We'll sell life insurance policy to school retirement system. This will qualify you for tax-free income. So we distribute 4% to you every year. And this income is tax-free. Okay, so this is almost like 8% if you're in California, right? So that's tax strategy on top of tax strategy. And then whatever is not distributed, the remainder will continue to grow there. And at the end of your life, this will go to your children without capital gain tax and without estate tax, because this is out of your estate. So it's a great tax estate planning tool as well. So if your income, your estate is beyond the limit, and right now it's 11 million, 12 million, per person, a couple 24 million, but most likely will drop to 5 million or 3 million, which will be 10 million or 6 million for a couple. So you can even do that now as an estimate planning tool, just put into the strategy like that. And then, it's away from your estimate. And then you can, when you put it in there, you take the deduction right now, right? So right now you still have high income. Well, let's do something like this. And then you can take the deduction. Even you don't sell the property, it's fine. You can do a valuation and then you take the deduction, right? That's also possible. So, and then the principal will go to a charity, which could be your donor advice fund, okay? Your family donor advice fund. So the donor advice fund is really simple. You basically the donor, you put the donor advice fund, and then you get a deduction, and then you can give money to charity or not. This year or next year, you can just keep it there. You take deduction already, and then in the future, when you give the charity, you don't get the deduction anymore. Yeah. The beauty is once you put it in there, it'll grow. The money continue to grow, tax-free. So another strategy is income shifting strategy. So right now, the C Corp tax is 21%. Now, your personal, if it's S Corp, flow to your personal, the highest is 39%. Well, this saves almost half. So that itself is worth it. And on the other hand, it also helps you to max qualify the business income because when you reach certain threshold, it reduces. And then you can park money for investment there rather than give to the IRS, and you can even lend the proceeds to businesses or to shareholder, yourself. And you can create like corporate sponsored life insurance plan, etc. Create a benefit plan under the C Corp. Now, why C Corp? Well, in the S Corp, there's called a 2% rule. If you are more than 2% owner, if you give yourself a corporate sponsored life insurance, it have to be deemed as W-2 income. Okay, you have to pay tax on it. But it's a C Corp, you don't have that rule. You can do that, and then the C Corp can also deduct the expenses, and then you basically transform the ordinary income into actually tax-free income, capital gain, because insurance income don't pay tax, right? So the way you do it is a S Corp. All you need is coming back to the beginning, your story, your business logic, right? The technical term is business logic. So everything you do is for business purpose. Well, you can say, I have a C Corp to provide IT service, okay? I have a C Corp to provide a marketing service, a management service. I have a C Corp as my family office to manage all my properties. These are business logic, in a plain word or story. And then you can pay a fee to a C Corp. So this is captive insurance. Basically, you say, okay, I have my business have risks that most other commercial insurance wouldn't provide the insurance for me, say data loss or loss of key employees, loss of key customers, key relationships. You have some these are insurance. Now you self-insure. So you basically create an insurance company, and then you pay insurance premium to that. And then, if you have risk, things happen, you claim it. If you don't, the money grow. And then the premium, it becomes a business expense. So you are shifting income in a way, a strategy. This is the code-based, for example. This is the called Augusta rule. You basically can rent your primary residence to your business, and then you do not have to pay you do not have to count it as rental income, but your business can count it as business expense, and you can do it 14 days. And make sure you check the fair market value like that to issue a 1099. And then this is a code-based qualified small business stock. If it's a C corp, domestic C corp, after the capitalization, your assets less than $50 million, and you hold it for 5 years, you can get when you sell the business, you can have $10 million exemption from capital gain tax. So that's basically what I have summarized. And of course, these has to be like technology business like that instead of personal service business or hotel and gas like that. So basically, you can just some people, they have this and the accountant don't know where to put it. Actually, it's very simple. The way we think is, what is it? If it's a capital gain, then it's Schedule D, capital gain. And then there's you report it, and then there's a code, Q. Then it's a negative amount, so you don't pay it. Okay. So, the reason I put this slide here is people debate, should I use S Corp? Should I use C Corp? Well, C Corp double tax. Well, I should do S Corp. Yeah, S Corp, you may save some tax during the next 5 years. But if you really look at that benefit of the qualified small business stock, probably C Corp is a better deal. And then C Corp also, do you have to pay double tax? What if you don't pay dividends? You don't have to, there's no double tax, right? Or do you even have to pay tax? What if you don't have profit? Like Amazon, they never pay tax and they get a huge tax credit. And people don't understand. People even strike and say it's not fair. But the reality is they use all the money, all the profit to invest in their technology. And then they apply for the R&D tax credit, which the government, the federal government give you about 10%. California give you about another 5%. So you actually get tax credit. People don't understand. And then you don't pay tax. Of course, you don't have profit, you don't pay tax. Well, then when you sell it, you got a capital gain tax free. What again, right? If you really look at it, America is one of the best places for entrepreneurs. Like America tax law actually is amazing. If you really look at it, like one of the things America is great is, I think we did some great things with our tax laws. We really incentivize people to be entrepreneurs and create opportunities for the society. And then also the charitable strategy, you think about that, how amazing it is, right? You create a charity, benefit the society instead of paying the IRS. And this one is, we talk about the context of, say if you have a 10 years old, 12 years old, you're thinking of financial planning for college tuition. Now, most people think, oh, I make too much money. I make $200,000, $300,000. I don't qualify for financial aid. Well, the reality is, let's look at the law. The law basically, look at the expected family contribution, and then they look at the assets. So these assets are excluded, interestingly. Home equity, retirement plan, so this is amazing. You put into retirement plan, you don't have to pay tax, and it doesn't help you to qualify for financial aid, right? So, and then cash value life insurance, annuity, family-owned business, and rental properties owned by family business. Well, interest in 5-2, this so-called college saving plan actually is included in the calculation. So I always say, hey, instead of putting 529, buy life insurance or put in Roth IRA, or even just put in your home equity. It's a better deal. So for example, in this case, you have home equity, so value 1.5, mortgage one, have home equity $1 million, and then banks saving $1 million, brokerage $1 million, 401k $1 million. So only these two are calculated as your assets. And then if you move this cash to pay off some mortgage, you reduce $5 million, right? Now, I again think about that to the context. You probably don't want to do that because mortgage is usually low interest, and it's with the long-term inflation outlook, probably you want to put into like a life insurance policy, and now it's only this money, right? So the point is that you can really, once you learn these, right, you can really creatively plan your tax and finance matters. So today it's 5:51. So today I'm going to stop here, and since we have only a few people, I'm going to open the floor. You can unmute and we can just discuss and have questions. You can unmute yourself and then ask questions.
Hi, Yanong, this is Ilko. Thank you very much for the informative presentation. I have no questions, but I really enjoyed my time with you.
Oh, thank you.
I worked with Michelle on our ERC filing, and I want to also thank her for that.
Oh, okay. Well, thank you for working with us.
Okay.
Yeah. Awesome.
Good night.
Yeah.
I'm interested in this shifting some of the income to the C Corp, but then when you want to take the money out, it comes out as a dividend. So that's going to be taxed again. So is there some way around that?
One way is do a corporate sponsored life insurance, and then now it transform from ordinary income to capital gain free, and you can borrow money from your life insurance contract. That's one way. Other ways, you can just always spend that, right? You can use it. You can travel. You want the money is for you to spend. Use it. You put it into your C Corp, and then you travel. Everything, it's in there. So, people, if you really look at the story, right? If I have more entities, I have more deductions. If I have an S Corp and I have a $1 million income and I deduct $500,000, well, as a professional service, I can stretch. Let's say I deduct 600,000, 40%. That's probably about it. If I keep going, you probably say it's probably lower than the average, and you start to getting attention. So instead of do that,
put that in a whole life insurance plan.
Yeah.
There's one way to do it. So you could do that, a whole life insurance plan out of the C Corp. Yeah. And then borrow on a whole life. How much of the whole life can you borrow? Is it like 50% like a 401k if you set it up right?
I have no idea these specifically. We work with experts. We are the tax strategists, more like generalists, but we work with experts and they're the specialists. So I think Josh is here today. Josh, can you answer that question? Josh is one of the people we partner with.
Yeah, happy to answer that question. The longer you hold on to the policy, the more you can borrow. And so when you first open these policies, depending on how much you fund, you might only be able to borrow, say, 20% to 50% of what you have. The longer you hold it and the more cash value you have accumulated, you can borrow up to 80, 90% of what you have in there.
But potentially the first year you could borrow 20 to 50%.
Correct.
Is this something, it's how it's written, or it depends on how the insurance agent has set it up?
It depends on how the insurance company and the agent has set it up for you. So whenever you put these in place, you want to properly fund them with, you know, the more you put in upfront, the more you can borrow, which is actually achieving your goal. The more you're trying to get a deduction, so you're trying to deposit as much as you can in there.
Yeah, and also, Michelle, you can always invest, right? You can use the money to either expense, fund your travel, whatever. You can also use the money to invest in real estate, anything like that. And then it's just the assets on the book.
Well, then you're not getting a deduction in the C corp. So if you're trying to, well, you get the deduction in the
Well,
S
then
corp if you get
then you do a depreciation. You can do a cost segregation depreciation. So you invest $1 million. Well, you probably want to borrow, some as well, and you leverage. So let's say you invest $1 million, but hey, with cost segregation, you may be able to deduct $300,000 the first year.
Sure, yeah.
That saves you, quite some money immediately, right? And you can say the C corp is my, family office, and I invest in whatever property I want to invest in.
Well, we'll have to get a presentation from Josh. The details of this.
Yeah, happy to help.
Yeah, you can. I can connect you, and you guys can talk. Look at the situation. Yeah.
Josh, aren't you the one that does the other? What was the other thing we talked about? The owner
401k.
devised fund. Was that you also, or that was someone else?
I've been on a few. I led the conversation on the college planning discussion in the past on the cash balance plan. Yeah.
Yeah, Josh is a retirement specialist. Almost all clients he's taking care of it, and he's awesome. He's very much a servanthood kind of person, take care of everything. Yeah.
Hey, Gene Hong.
Yeah. Hey, Bill. How are you?
Hey, good. How are you doing?
Good. Good.
You see Joshua.
Uh,
Hey, Bill.
Hey, on that, just remind me the self-insurance you mentioned. Is that for an S corp or a C corp, or
Josh, why don't you take
the
it?
employee insurance?
Yeah, that's probably referring to the captive or micro captive, and those are created under a C corporation as well.
Yeah. Okay.
I think that one is not considered an employee benefit. So I'm thinking even S corp is okay, right? Because it's just the insurance.
No, the way I was speaking to someone today, an expert, and they only create them under a C corporation. So a C corp has to be created, and it's kind of like an income shifting strategy as well. It is not employee benefit strategy, but
you mean the insurance company has to be C corp. That I understand, but you can do the insurance under S corp, correct?
Oh,
Because
yes. Sorry. Yeah, correct. Any company, any type of corporation can implement that strategy. It's
Yeah.
just whenever you actually fund the strategy, it has to be utilizing a C corporation.
Yeah, because it's not an employee benefit.
Right.
So, you can do it under S corp. But
Are we talking about like the whole life insurance, or this is a different insurance?
I'm talking about the
Captive.
commercial insurance. It's also called a captive insurance. Basically like self-insurance. This is another strategy, income shifting strategy. So you can say, I have some risks that I can't buy insurance from the major Allstate, State Farm. So I created my own insurance fund. And then the insurance premium become business expense. But if you don't have claim, the money is saved somewhere else. And then when you retire, you can terminate and you pay capital gain tax, and and you can, use it as a retirement plan. Or,
Okay, so that's a deduction though. It's a
Huh?
deduction for that. That's a deduction.
Yeah.
The whole chunk of money is a deduction.
yes, exactly. Yeah, but the money
It
is.
seems like it's an asset, but it's not. You're saying it's not.
Yeah, because for the company, for the operation company that's paying insurance, that is insurance premium expense. So it's a deduction, right? And then for the insurance company, yes, it's an asset. But you don't have to pay tax on that. I think there's a law, like it's called a small, like micro insurance company. You don't have to pay tax on that. Josh, am I correct? Like you even don't have to pay capital gain tax for the growth.
That's correct. It kind of acts like a retirement plan where the assets grow tax deferred.
Yeah.
So while the assets are sitting there in the pooled account, ready for, say, a claim, the claim is not ever filed. It's invested and it grows.
Yeah.
And later, if there's never a claim, then it gets distributed amongst the partners, the owners of the firm.
Yeah, and then at that time again, you can use one of these charitable strategies we mentioned, and you don't have to pay capital gain tax, and then you can just receive tax-free income. So by doing that, you
I
save.
don't assume you can borrow against it. So this is more like it sits there, but it's yours, and you've got a big deduction.
Correct.
Okay. It
I-
reduces your taxable
think-
income.
Can you borrow money from the insurance company?
You just said
No.
no.
I don't believe so.
Yeah, because it's like insurance, it's it's a conservative, you have to keep the money in there. Yeah. So
So
business.
does it sit like, is it getting interest? Is it growing?
Yeah, you can invest in anything you want,
So it's kind of self-directed or not?
Yes.
Yeah, I guess it's really by you are finding an advisor, and it's really your risk profile, you can work with you have full control, different control. I guess Josh, you correct me. I guess there must be some restrictions since it's insurance. They don't want you to take ultra high risk, right?
That's correct. It's typically moderately managed. You typically use an investment firm, or you can manage it yourself. But there's an investment policy statement that has to be put together and created to ensure that the investments are invested appropriately.
Yeah.
So that's there if you need it.
Yeah.
So
So-
where could we get a list of the restrictions? I mean, could you invest it in real estate like you do a self-directed retirement plan or not?
No,
It's usually annuities and that kind of thing.
no, it's typically stocks, bonds, mutual funds.
Yeah, I think they want to keep it.
I don't think Bitcoin's in that availability list, Michelle.
Yeah.
Everybody knows I bought Bitcoin. I didn't buy it at 63 though. Definitely. I'm just sitting on it, waiting for it to go back up.
Do you have
Good
that?
question.
Can you show that slide, Jinghong, that was talking about this? Because it went by kind of quick. You mind?
You mean the self-insurance, right?
Yeah, I believe that was it. It showed that it's like a flow chart. Oh, this one. Yeah.
Yeah. So
So your captive insurance company is the C Corp we're talking about.
yeah.
You essentially create your own insurance company.
Mhm.
I need a copy of that slide. You can PDF that to us all.
Yeah, you can do that.
Be great.
Yeah.
So the key is like you just have like key employee insurance, for example, as your policy for an S Corp.
So I'm just giving examples. So the way you do it is, Bill, really, it's your imagination, right? Just usually what we do is we partner with a company who does these insurance, and then what they do, they will interview you, they will talk to you, and then they ask questions, and usually you'll find something. Like we do the ERC, and we ask questions like, okay, do you have to follow social distance like that? We should ask all these questions, and people understand. And people say yes, yes, and we'll create something you qualify. So we document everything qualify. Yeah. So they do these business, and they understand the laws clearly. Yeah.
And just to be clarified, that they're not life insurance policies. Like Jinghan said, they're more commercial policies. Trucking companies use these, dental doctors use these, maybe marketing agencies use these even to protect against slander or their image. I mean, there's some pretty unique scenarios that you can use these for to protect against loss of a risk.
Yeah, I think also this will cost. It's there's some cost associated with it. So usually you should have like $2 million revenue, to reasonably have established something like what $500,000 something, right? And then there's another cheaper version of it. It's more like co-insurance. So we have found a company. Josh, I'm talking about Lamar's alternative strategic insurance. They are more like coming from a co-insurance perspective. So they will co-insure, I think 10% or something. So basically, whatever you put in there, you pay them 10%. So that's kind of like your cost. And then when something happens, I think they will co-insure 20%. But consider like this 10% is cost. But even that 10% actually is cheaper than the other ones, right? The other ones are more expensive. They more have like fixed fees and quite expensive, even more than 10% of the cost, I think.
So this is people who are making over $1 million a year.
Yeah, I would say that.
Okay.
Yeah.
Definitely.
So we need
Yeah,
to see
it's-
the lower price.
Yeah, I think the low hanging fruit, the low ones like a donor advice fund and charitable LLC, and I think even corporate sponsor life insurance. These are, I think these are more reasonable. What do you think, Josh?
Yes. Yeah, the captive is a little bit for a larger firm.
Mm-hmm.
The other ones you mentioned are more attainable,
And also
$500,000 to $2 million.
Yeah, if you have the cash and you want to save some tax and have some good rate of return, put into oil and gas. I think it's a good one. I think oil and gas in general will continue to, and the key here, oil and gas, is you find a good product. And I have been using my financial advisor, Jeff Fisher, and he's very good at alternative investor. So he, if you want, I can connect to you. He will always invest in companies who are already drilling and already producing oil, and then they're drilling, at the other side. So almost 100%. It's going to be productive oil wells. Yeah. So that's why that's the only code-based vehicle where even if it's a passive income, it's passive loss, right? You don't participate, but you can use it to offset your active income. So if you do, and then usually 80% of it. So if you put $100,000 there, $80,000 deduction right away.
That one was what again?
Oil and gas.
Oh, oil and gas.
Yeah. Or drilling cost. Yeah, but buy real estate and then do cost segregation. From investment perspective, it's a great way.
My plan, the real estate.
Yeah, and then you can play some income shifting by shifting some income right from S corp to the C corp, and then buy real estate in the C corp. This way, you kind of just to spread out your income into two entities that give you more reasonable deductions.